Boise, it is hot. It's supposed to be in the hundreds this week. So stay cool. And hopefully you'll be able to do that and keep moving forward. Hot weather. It's kind of tough to swallow sometimes, but we'll make it through this. So speaking of hot, so we have hot charts going on right now. As you can see here, the universal mortgage-backed security has dropped 33 basis points, which is not a small drop in one day. However, it's unfortunately kind of the name of the game nowadays. It seems to go up and down in large jumps a lot of times because we do not have quantitative easing by the Federal Reserve. We haven't had that, of course, for almost a year and a half now. So we're seeing a lot more swings in the market every day. So let me go over what we're seeing here today. This week, of course, there are no major economic reports or news items coming out. So there's no inflation reports. There's no jobs report. The only thing coming out is Wednesday. We have the Federal Reserve July minutes that they're going to release from their July meeting. So those minutes, the market is kind of concerned about that and not sure which direction to head as far as the bond market. Concerned that there are a number of Federal Reserve members who have come out more publicly lately saying that they are in favor of rates continuing to be increased to get that core rate of inflation down another 2% into the twos. We're still in the fours on the core CPI and the PCE. So it's a situation where, there may be some indication of some momentum, movement, and pressure to continue to raise interest rates. But there are other board members who are saying, hey, I think we've gone far enough, fast enough. Let's see what happens and let it sit for 6 months. So we'll see which side appears to be winning from those minutes. The government is hedging its bets here and saying, taking a worst case scenario approach, as you can see on the charts here, and saying, hey, it's probably going to be bad news. So we're going to price that in. So it's possible that we could see things go the other way Wednesday afternoon if the market prices in too much of a negative spin ahead of time. So what I'm showing you here, the chart you're looking at, this is the 10-year Treasury. You can see it's up 3 basis points to 4.2. There is a ceiling of resistance here, a Fibonacci level at about 4.3, 4.24. That's a pretty important one. If we breach that, then we will be going higher than we went last fall on the yield for the 10-year Treasury. Mortgage bonds and mortgage rates tend to follow the 10-year Treasury a bit. So quite a bit. There's a pretty tight correlation there. Not perfect, but a tight correlation. So if that breaches that Fibonacci level, then that could portend some bad news for mortgage rates. Let's take a look at the mortgage-backed security, universal mortgage-backed security bond chart. Again, this is inverse to the 10-year Treasury. We're not showing the yield on this chart. We're showing the price of the bond. So the higher the price of the bond, the lower the rate and yield. As you can see here on this chart, we've got prices that have been falling fairly dramatically over the past 5 trading days. Not any relief here yet, right? Now we're hitting this Fibonacci level that we dipped below today and then came back up above and have closed above that level, which is good news. So maybe that'll hold as a floor of support. If not, we'll be down to the next one. The challenge is this. When you look back about a year here, let's look back a year on the chart, you're going to see that we are now at price levels that are nearing what we saw last October and November, which were the worst rates we'd had, right? That we've seen since like 2000. So yeah, we're getting close to that point, unfortunately. Not there yet. If we break through this next floor of support here, the next floor down is that level of 97 that we were at last October. We hit it the 14th and the 21st of October, which were the worst rates we've seen, like I said, since the year 2000. So we're getting to that point. Hopefully that hangs in there and we don't get any worse than that. And the Federal Reserve behaves themselves and doesn't raise rates too much faster or too much further. Hopefully not at all if we can avoid it. But again, we do need to get inflation under control so that our dollar has value going forward. That's the most, the bigger picture thing here. And hopefully the Fed can correct their mistakes of leaving quantitative easing and keeping rates too low too long back during the pandemic. That's what they're trying to correct here. And it's kind of a mess, as you know. So hang in there. Let's keep going. Things will improve. We have seen, at least me personally, have seen business uptick in purchase business on real estate this past month or two. So I'm actually getting busier now than I was even at the beginning of the summer, which is kind of surprising based on where interest rates are. But I think it's a combination of people thinking that, hey, may as well get in now if I need to buy a house, which is true, right? If you need to buy now, it's a good time to do it because, as you know, appreciation has continued to happen. We have had some recovery and some improvement in prices, appreciation prices, even here in the Boise market that was overheated a year or two ago. We've still seen some improvement over last winter. And so people are like, oh, better get in now. And I think that's a wise move. You can always refinance later if rates come down, which they will at some point in the future. But hey, if somebody needs to buy a house, encourage them to do so. I have a cost of waiting analysis that's fantastic that can show them the numbers and show them why it makes sense to move forward now rather than waiting. Marry the house, date the rate. I think that is an accurate, even though it's overused now by the industry, it is an accurate phrase. Have a great week.